is the appropriate accounting methods for view-centric Berhad to record the investment in acquisite Berhad and a measure scheme Berhad. View-centric need to record the cost of investment initially at cost, which will be the consideration transferred. Subsequently, the investment can be accounted for either A, at cost, or B, in accordance with FAR610 Financial Instrument Recognition and Measurement. There is only one method of consolidation, that is the acquisition method. Okay, under this method, a business combination is viewed from the perspective of the investor, which is view-centric Berhad, as the acquirer. View-centric is the party that recognizes the cost of the business combination, which is the consideration given or transferred, the asset acquired and liabilities, including contingent liabilities, assumed by acquisite Berhad and a measure scheme. So, acquisition method involves 4 steps. First, we need to identify the acquirer, which is view-centric Berhad. Second, we need to determine the acquisition date, which is for acquisite Berhad is on 1 January 2016, and a measure scheme Berhad is on 1st March 2018. C. Recognizing and measuring the fair value of net asset and NCI. And the last step is recognizing and measuring goodwill or bargain purchase. The total of consideration transferred will be the initial cost of the investment, which will be recognized in the financial statement of the investor. Okay, so the reason why we need to use acquisition method instead of purchasing method is because purchase method accounted for an acquisition as the sum of assets and liabilities being acquired. On the other hand, acquisition method views the purchase as the whole firm, not just the sum of part of it.
Okay, next we move to question 1B, which is the computation of the goodwill or bargain purchase for the acquisition of acquisite Berhad and also a miskin Berhad. So first, for the acquisition of acquisite Berhad, we calculate by LLC consideration transfer, which comprise cash 224 million plus with the NCI at fair value, which is 56 million. So we get the total of 280 million. We minus with the fair value of net asset of acquisite Berhad at DOA. So it's comprised with OAC 200 million, pre-return profit 12 million, pre-general reserve 45 million, and ARR 5 million. So the total for fair value of net asset at DOA is 262 million. So from the consideration transfer, we minus with the fair value of net asset, we get the goodwill of 18 million. Then for acquisite Berhad, there will be impairment of 10%. So the total for the goodwill is 16.2 million after we minus with the. Okay, then for the acquisition of a miskin Berhad, for consideration transfer, we comprise of cash amount 100 million plus share acquired payable 216 million. So we get 360 million. We plus with the NCI at fair value, which is 200 million. So the total for consideration transfer is 560 million. Then we minus with the fair value of net asset at DOA, which is OAC 400 million, pre-general reserve 10 million, pre-return profit 69 million, ARR 2 million, and profit for the current year 6 million. So the total for fair value of net asset is 487 million. Consideration minus with the fair value of net asset, we get the goodwill 29 million. The overall total for goodwill is 45,000.2 million and NCI is 250 cents. For question 1C, which is the computation for the schedule of the equity, for the NCI, first acquisite amounting 56 million, a miskin 200 million. Then for the return profit of HC is 194.8 million minus URP of inventory 4 million minus URP inventory 7,060. So we minus with dividend payable 24 million plus with debenture interest 400,000. The total for return profit of HC is 160.44 million. So we transfer it to the group return profit. Next, for return profit for acquisite, 63.68 million minus with pre-return profit 12 million. So we get the post-return profit, which is 51.68 million. We minus with the URP plan, which is 2 million, plus over provided of depreciation for plan 200,000, minus with dividend payable 12 million, minus with the under provided of depreciation for property, which is 600,000. So the total for return profit of requisite is 37.28 million. Then we apportion for the NCI, which is 20%, amounting 7.456 million, and for group return profit is 80%, which amounting 29.82. For return profit of a skin, amounting 105 million minus pre-return profit 75 million, so we get the post-return profit, which is 30 million. We minus with the under provided of depreciation, which is 400,000, so we get 29.6 million. So for general reserve of HESI is 30 million, then we transfer with the group general reserve. For general reserve of requisite is 45 million, minus with pre-general reserve, which is 45 million, so it will be 0. For general reserve of skin, 10 million, minus with pre-general reserve 10 million, it also gives 0. So the net amount of NCI is 275.296 million, group return profit 214,024 million, and lastly for group general reserve.
So move on to question 1D SOPL. So first we start with revenue. We need to add the HC and all the subsidiaries revenue. But as for MSC Skin, we need to apportion its revenue according to the month of acquisition, and then we need to minus all the adjustment, and we will get the answer 1.9118 million. Okay, so next minus with cost of sale, which is 547.460 million, and we will get gross profit 1.444.34 million. Next, we need to add with other income, which is rental income, amounted 23.6 million, and dividend from other investment, which is 31.9 million, and minus with operating expenses, which is 510.2 million, and the bench interest will be 0. In payment of goodwill, which is amounted 1.8 million. So we will get profit before tax 987.64 million. So next we need to minus with taxation 78 million, and we will get profit after tax 909.84 million. So for other comprehensive income, there is a surplus or revaluation amounted 30 million. So the profit attributable for acquisite will be 2.716 million, and MSC Skin 14 million, and the balancing figure 893.124 million. So as for total other comprehensive income attributable, we need to, as for MSC Skin, we have surplus or revaluation, so we need to times with the percentage of NCI, and we will arrive at the total of 26 million for MSC Skin and 2.716 for acquisite. See 911.124 million. Next, we need to attribute the profit according to HC and NCI. So for NCI, we need to calculate according to working one. So PAT of subsidiary minus with URP minus with overvalue of depreciation, minus under provided depreciation, and minus preferred dividend. So after we arrive at the total of for exquisite 13.58 million, we need to times with percentage of NCI, which we will get 2.716 million, and for MSC Skin we will get 3.6 million times with percentage of NCI, which is 40%, and we will get 40 million.
Question 1E. Consolidated statement in changes in equity of Bios and Triberhide for the year ended 31st December 2018. Balance BD for the group return profit, which is return profit as per site, which is 54.1 million minus pre-return profit 12 million, and then we get 42.1 million. Then the portion is 80%. Then we get 33.68 million. And retain profit holding company minus retain profit as per site, and then we get 132.68 million. For balance BD for retain profit of NCI, net asset of subsidiary at date of acquisition comprises OSC 200 million plus pre-retain profit 12 million plus ARR 5 million and plus pre-general reserve 45 million, and the total is 262 million. Then we times with a portion of for NCI 20%, and then we get 52.4 million plus and non-redeemable preference share capital 0 and debentures also 0, and then we plus with post return profit 42.1 million times 20% for the portion, and then we get 8.42 million. Then 52.4 million plus for the post return profit 8.42 million. Then the total for balance BD for NCI is 60.82 million. Next, for Chinese equity for group return profit, first balance BD 132.68 million plus profit for the year from the SOPL 893.124 million minus OSC dividend 70.38 million, and the total we get is 955.424 million. For NCI, balance BD is 60.82 million plus profit for the year 16.116 million plus acquisition for the year 218 million. Then we minus OSC dividend 1.2 million, and the total is 293.736 million for the year. For Amazing Skin, fair value of net asset of subsidiary at DOA comprise OSC 400 million plus pre-return profit 75 million plus ARR 30 million plus pre-general reserve 10 million and plus profit for the year 30 million, and the total we get is 545 million. Then we time for question for NCI, which is 40%, and we get 218 million. Then we plus with non-redeemable preference share capital, which is 0, and the total for acquisition of the Amazing Skin is 218 million.
Okay, for the last but not least, question 1L, SOFP. Assets comprises of property 793.4 million, plant and machinery 456.2 million, other investment 419 million, inventory 200.24 million, trade receivables 57 million, base receivables 61 million, bank 118.28 million, cash in transit 3 million, intangible asset 1.6 million, goodwill 45.2 million. So for the total assets is 2154.92 million. Next is the equities, comprises of ordinary shares 1 million, group general reserve 30 million, group retained profit 214.024 million, group asset revaluation reserve 85 million, non-controlling interest 275.296 million, and current liabilities, redeemable preference shares 200 million, debentures 5 million. For the current liabilities, comprises of trade payables 140.6 million, bills payables 31.28 million, interest on redeemable preference shares 12 million, ordinary dividend 24 million, total equities and liabilities 2017.2 million.
Move on to the question 2.
A. What is the meaning of joint control as specified under FAR610 joint arrangement? Control is where the parties contractually agree to share control and which exists only when decision about the relevant activities requires the unanimous consent of the parties sharing control. An entity that is a party to an arrangement shall assess whether the contractual arrangement gives all the party control of the arrangement collectively. Parties must act together to direct the activities that significantly affect the returns of the However, no single party controls the arrangement on its own, but a party to join a control can prevent the other parties from controlling the arrangement. Besides, there could be parties that do not join the control. For example, 4 parties have an interest in joint arrangement. 3 out of 4 parties have joint control and 1 does not. So the party that do not have the joint control is the party that participate in but has no joint. Next, question 2B1. Describe the type of joint arrangement and its accounting treatment in accordance to FAR610 joint arrangement. Based on the situation above, the type of joint arrangement above is joint venture. Joint venture is where the parties have right to the net asset but not have the rights to the net assets and obligation for the liabilities. In this case, only Delta Berhad and Global Berhad have right, title and ownership of the assets to the arrangement, and Yasser Berhad not own any, so its venture shall recognize its interest in a joint venture as an investment and shall account for that investment using the equity method in accordance with MFRS 128. The investment in joint venture is initially recognized at cost and carrying amount is increased or decreased by the investor's share of the post-acquisition profit or loss of the investee. Dividends and other distribution from the investee reduce the carrying amount of the investment. The carrying amount of the investment in joint venture is disclosed as a non-current asset unless the investment is classified as held for sale in accordance with MFRS 5 non-current asset held for sale and discontinued. Next, question 2B2. Okay, assuming that Yasser Berhad has the right to its asset and obligation for its liabilities, would there be any difference to its accounting treatment? There will be different in the accounting treatment since Yasser Berhad has the rights to the asset and obligation for its liability, so it's a joint operation. In a joint operation, the operators will recognize in their own financial statements the interest in assets, liabilities, revenue and expenses in the joint arrangement. At the end of the reporting period, a memorandum statement of profit or loss may be prepared to determine the share of profits of each operator. In the separate financial statements and in consolidated financial statements, the operators have to disclose their shares of the jointly controlled assets, liabilities they have incurred, their share of revenue and expenses.
Question 4. A director of Bumi Kenyalam Berhad argues that control may not exist when an investor holds less than 50% equity interest in an investee. Meanwhile, another director argues that even if the holding interest is less than 50%, the investor may have control if it has the ability to affect the returns in the investee. So, the question is, with the reference of MFRS 10 Consolidated Financial Statement, explain the above arguments. MFRS Consolidated Financial Statement provides guidance for determining whether the control exists or not. When an entity acquires control over another entity, the acquirer is called the holding or parent entity and the acquiree is called the subsidiary. Together, they form a group, although both entities remain separate physically or legally. An investor determines whether it is a parent by assessing whether it controls the investee. The investor controls the investee only if it has all the following. First, it must have power over the investee. Second, exposure or rights to variable returns from its involvement with the investee. And lastly, the ability to use its power over the investee to affect the amount of their investors. A director argues that control may exist even though they hold less than 50% equity interest in an investee, while another argues that even if the holding interest is less than 50%, the investor may have control if it has the ability to affect the return of the investee. Okay, the argument by the first director is acceptable because to determine whether an investor has control or not, it must satisfy all the requirement of control. However, in this case, the investor only satisfy the requirement of having the ability to affect returns in the investee, but not having the power and having exposure or rights over the investee. If the investor holds less than 50% equity interest in an investee, he can only be an associate or just a simple investment in the investee.